stop listening to the promises. When it comes to solving the housing crisis in Canada, the government's biggest goal, its most critical metric, is not just failing, it is collapsing. And the collapse is not a prediction, it's an established fact in the latest housing data. This failure has one simple, undeniable consequence for every Canadian homeowner and prospective buyer. Housing prices are not going down, they are only going up. We've all heard the same target. Canada needs millions of new homes built by the end of this decade to restore affordability. But the reports, the raw, undeniable data on housing starts, show that we are currently falling short of that annual target by a devastating margin. This isn't just a slight miss. This is a systemic breakdown in the national housing supply chain. In the next 12 minutes, we are going to expose the 5 critical data points that prove the housing starts myth is driving prices higher. We'll break down the CMHC's own numbers, analyze the 3 hidden policy bottlenecks, and reveal why a shortage this deep and this systemic makes a broad market crash mathematically impossible. Let's start with the facts on the ground, pulled directly from our national housing data. The official goal set by the Canadian Mortgage and Housing Corporation, or CMHC, to return housing to 2003 to 2004 levels of affordability requires Canada to build approximately 3.5 million new homes by 2030, above and beyond the usual pace of construction. That translates to an estimated annual construction rate of over 500,000 units per year. This is the goal. Now, look at the reality. The most recent 12-month rolling average for housing starts across Canada is barely over 250,000 units. That is an average annual deficit of 250,000 homes. In pure economic terms, this is not a housing crisis. It's a national inventory disaster. Think of it like a store trying to restock its shelves. If they need 500 items a week but only manage to get 250, the shelves are not just staying empty. They are getting emptier faster than ever before. This gap is the single most important metric in the Canadian real estate market right now, because it is the fundamental pressure gauge on price. Every year we operate at this deficit, we add 250,000 units of pent-up demand into the system. It is a shortage that is feeding itself, and the primary reason why any small dip in price is immediately bought up. Why is this happening? It's not a lack of money or lack of demand. It's a policy-induced paralysis, and the data pinpoints 3 major culprits that successive governments have failed to address. The first piece of data is the average approval time for a multi-unit housing project in major Canadian metropolitan areas. In cities like Toronto and Vancouver, the average approval time can still stretch well over 18 to 24 months. Compare this to the global average of 6 to 8 months in high-growth nations. Each day added to the permitting process is a day of higher carrying cost for the builder, which is simply passed on to the buyer as higher prices. Our bureaucracy is literally taxing the construction process. The second piece of data is the job vacancy rate in the Canadian construction sector. Official labor market reports show that the construction sector is facing a severe shortage of skilled tradespeople. This isn't a small issue. Some estimates suggest we need tens of thousands of new skilled workers. With limited labor, the 500,000 unit annual target is impossible to meet. The labor market has its limits, and housing starts are hitting that ceiling. The final and most immediate factor is the interest rate environment. The Bank of Canada's aggressive rate hikes, while aimed at tackling inflation, have made construction debt astronomical. Developers operate on borrowed money. When the cost of that money doubles or triples, projects that were feasible a year ago are now financially unviable. We are seeing major projects being shelved, not because of a lack of buyers, but because the cost of capital has exceeded the potential profit margin. This is not just theoretical. We can point to specific projects in every major city that have been put on indefinite hold due to financing costs. This data tells us that high interest rates aren't cooling demand as much as they are freezing the supply pipeline. So, what does this systemic supply failure mean for the future price of Canadian real estate? The answer is simple. The laws of supply and demand are absolute. Economists use a term called price elasticity of supply. When supply is highly inelastic, meaning it can't quickly increase to meet demand, which is exactly where we are now, prices react violently to even small increases in demand. Canada's demand is not small. It's being fueled by historically high immigration and a record number of young adults entering prime buying years. The data confirms this dynamic. Look at the price action in any major Canadian market over the past 5 years. Every time the market slows due to interest rates, the drop is minimal, a temporary blip. As soon as there's a hint of a rate cut, prices surge back, often exceeding their previous highs. Why? Because the underlying supply gap has not been closed. It has only widened. The myth that a massive US-style housing crash is imminent in Canada is exactly that, a myth. The only way you get that type of crash is if supply suddenly floods the market, or if demand disappears entirely. Given the current deficits in housing starts, supply is going in the opposite direction. And with government policy heavily reliant on continued population growth, the demand is baked into the cake. We are living through a national policy contradiction. Policymakers are announcing ambitious goals to fix housing affordability, while simultaneously overseeing a regulatory and economic environment that ensures construction goals are fundamentally unattainable. For you, the viewer, the takeaway is clear. The most important housing data is the one showing new construction. As long as the annual number remains at 250,000 units while the required number is over 500,000, the mathematical reality of Canadian housing is that the pressure is always upwards. Expect prices to remain sticky and to rapidly accelerate with any favorable shift in interest rates. The long-term solution lies not in market cooling, but in a complete radical overhaul of the supply bottlenecks we've outlined. Until those changes materialize, the Canadian housing market will continue to defy gravity because the foundation, the lack of supply, is simply too strong. If you found this data breakdown valuable, make sure you are subscribed. We track the numbers that matter so you can make the right decision in this chaotic market.